Hey, what's up, everybody? Mike Norman here. It is Wednesday, February 7th. Let's do a little market update. So, a lot of action over the past several days, actually, since last Friday when we initially had that 666 point drop in the Dow, followed by Monday, 1,174 point drop in the Dow, followed by yesterday's 560 or 570 point rally, followed by a rally today, which ended up giving everything back towards the close. So what is going on? Let me try to make some sense of all of this. It seems to me, and this is something that I had been talking about a while back, that the market has come in contact with a threshold of bond yields, of interest rates, bond yields, that is now presenting some significant resistance for the stock market. Bond yields, by the way, we can go back over a month ago when the 2-year note had a higher yield than the dividend yield of the S&P 500. So we crossed that threshold over a month ago, which was a threshold that had been in existence for over 10 years, where the S&P dividend yield was higher than the 2-year Treasury. Okay, but that flipped about a month ago. I talked about that in MMT Trader, and that has only continued to widen that gap. So it favors the 2-year note, which is a risk-free instrument, if you look at the yield over the dividend yield, all right? And as I said, the trend has been widening in the direction of the 2-year note. So we have now a condition that we have not seen in a decade, where fixed income treasuries on a yield basis are more attractive than the S&P, the dividends that stocks pay, in the aggregate, the S&P dividend yield, all right? Last Friday, when we got the employment report, and I spoke about this, even though, it was a moderate increase in payrolls, 200,000, I was expecting a much higher increase. What I picked up on in my analysis, or what the analysis picked up on, was the very strong rise in wages, which put average hourly earnings at growing at the fastest pace now in 9 years. Okay, and that's what triggered that whole sell-off. We had the 10-year Treasury yield jumping over 2.8%. It got up to like 2.84, 2.85. Market sold off. Market sold off on Monday, in a very big down move. You got a flight to quality. 10-year Treasuries pulled back. You had a bounce yesterday. You had a little bit of a bounce this morning. But now, 10-year Treasuries back up at 284, 285. Market seems to be running into resistance every time we get up at that level of the 10-year Treasury. Now, let me throw a new thing in here. Not new, but let me throw another element into the analysis. And that element is the economy is very strong. We're running well over 4% growth in the first quarter. There was a estimate of 5.4% by the Atlanta Fed. It was recently revised a little bit lower, but it's still between 4 to 5%. It's very, very strong. We haven't seen that in years, okay? We haven't seen that through all the Obama administration. We never got over 3%. On a year-over-year basis. So very strong growth. So on the one hand, the strong growth presents a bullish scenario for stocks, right? What are stocks? Shares of businesses. Strong growth translates into, or it should translate into, higher earnings, higher profits, stronger growth in the economy, etc. But it also translates into higher interest rates because the Fed will react to that by raising rates. It also translates to higher inflation which could hurt many companies. All right, so you have these forces. On the one hand, strong economic growth. On the other hand, the Fed's reaction to that, which is going to be hiking interest rates, all right, rising bond yields. Now, a new thing, another element potentially just came into the picture today, and that is that the Senate, in a bipartisan agreement, agreed on a 2-year budget deal. Now listen to this, because this is big. 2-year budget deal which lifts spending, eliminates all spending caps, lifts spending on military and domestic programs by a total of $400 billion over the next 2 years. Not 10 years, the next 2 years. That is enormous. Plus, it lifts the debt ceiling. Okay, so we remove the impediment of the debt ceiling. Now, this is another factor. Now, let me just mention that it has to be passed. All right, it has to get a vote in the Senate. It has to get a vote in the House. There is some opposition welling up because they're all like, oh, this is too much spending. The spending is good. But here's what's going to happen. So, you basically have the scenario I just described where you have these two forces fighting against each other. You have the high spending and the strong economic growth, boosting activity and all that. But then you have the inflation effect and you have the reaction, what is certain to be the reaction by the Fed in raising interest rates. So what does that mean? It means for stocks, it's a tough call because you have these two opposing forces. You have on the one hand what's going to be a very, very strong, if this deal passes, let me just tell you, we could be 6%, 7%, close to 7% economic growth. We could easily be 6% annually. It's going to be like going gangbusters. So that's positive. But along with that, you're going to have inflation and you are going to have undoubtedly, without question, the Fed's reaction to that, which is going to be an accelerated and prolonged cycle of rate hikes. No question. So the real position you want to have here is a line like an inflation position. You want to be short treasuries. That's the best trade of anything right there right now. You want to be long inflation, which means gold, which means short the dollar, probably long oil. All right, now, speaking of oil, I sent out my weekly EIA petroleum report, summary, analysis, and breakdown today. If you want a copy of that, go to my website, pitbulleconomics.com, and sign up for a 30-day free trial of MMT Trader. Very important that you see that report. That was an interesting, I have to say, that was an interesting report today. Because aside from the detail, there were, like the stock market that I just described, sort of some conflicting elements in there. I shouldn't say conflicting, but things that need further clarification. How are we going to get further clarification? We need to see what the data is next week. All right, there are some things in there that look very, very bullish, and there are some things in there that look like it's a setup for a major sell-off. And then you have to consider, the economy, the growth in the economy, the stock market, all that stuff. So like I say every week, it requires a synthesis of that information. That's what I do. All right. If you want that email that discusses that report, go to my website, pitbulleconomics.com, and sign up for a 30-day free trial of MMT Trader. As far as this dollar rally is concerned, I am selling into this, okay? The dollar rally will not last. I will repeat, the dollar rally will not last. Inflation does not result in a higher foreign exchange value of the currency. If it did, Zimbabwe would have the strongest currency in the world. Okay? All right, everybody. Enjoy. Bye-bye.